Hey Bowtie Nation, Joseph Hogue here, and following our recent video on short-term investments, I wanted to get back to what we do best here on the channel, picking those long-term buy and hold forever stocks. In these forever stocks, we're looking for stocks to buy that could become the next Apple or Amazon, producing 10x returns over the next 5 or 10 years. And why I wanted to update these buy and hold stocks now is because we're seeing some great opportunities after the recent sell-off. I don't know what it is, nation, but investors scream bloody murder when stocks fall, but this is your best chance, your best opportunity to pick up stocks at a huge discount for future returns. As an example, one of my favorites here jumped from just $5 a share to almost $12 in just 2 months this year, and investors were kicking themselves for not buying more. It's now down 35% from that high, giving investors another chance to jump back in on a stock that could reach $20 or $30 over the next 5 years. Don't forget to join the community by tapping that subscribe button so you don't miss a single episode, and be sure to check out that short-term investments video that I'll link in the description below. First though, I wanted to share a special offer from one of the stock research tools I use. Writing for Seeking Alpha was one of my first analyst jobs back in 2010, and I've used the site for research ever since. You'll find analysis for every stock, and more importantly, both sides of the story to make sure you're getting the upside and the risks. I have premium access for the stock screeners and other financial information. You can listen in on earnings reports and get analyst expectations. And right now, with the promo code I'll link in the description below, Seeking Alpha is offering a 7-day free trial to premium access. Try it out. If you like it, you're going to get a $50 off with the promo code in that link. It's totally free to try out and some great features, so look for that link below. My first buy and hold forever stock isn't going to surprise anyone in the Bowtie Nation because it's been one of my favorite stocks for a long time. SoFi Technologies, ticker SOFI. I started buying SoFi in April of last year and have increased it to 21,000 shares. It's the largest position in my portfolio and up $36,000, but besides going a lot higher from here, this is a new opportunity right now. Shares of the online bank reached $11.70 in July, a bounce of 134% in just 2 months, and investors were kicking themselves for not buying more. Now the shares are back down to $7.50 and could be a second chance to get in. Nation, SoFi is going to be a major bank. Even in the biggest banking crisis in 20 years, when most small banks were hemorrhaging deposits and users, SoFi added more than 1 million users in the first half of the year. It's growing that by more than 40% a year. Revenue grew at a 37% pace in the most recent quarter and is expected to grow at least 25% through the next year. The recent end to student loan forbearance is going to bring back a major revenue stream for the company, since it did start out as a student loan refinance platform, but SoFi has grown into an all-in-one financial app. Most importantly here, SoFi is one of the few fintechs with a banking charter. That means it can collect cheap deposit funding for its loans and other products. And that is a real competitive advantage it has over its fintech peers, and that's driving that stronger growth. SoFi recently added another revenue stream, investment banking, with its underwriting of the Instacart IPO. Now, it's still just $10 billion in deposits right now, which makes it absolutely tiny as a regional bank, but SoFi is going to be a major bank. Even a deposit base of $50 billion would still make it just the 47th largest regional bank in the US, but at a 1.3 times price to book valuation, that'd be about a $36 stock, nearly 5 times its current price. Next here, cybersecurity stocks were the standouts this year until a mid-year crash, and Fortinet, ticker FTNT, is now trading at a 30% discount. Today's connected world and a revolution in artificial intelligence means cybersecurity is one of my favorite growth themes. And Fortinet is a leader in this space with nearly a third of the market share, dominating peers like Palo Alto, Cisco, and Check Point. That market opportunity for cybersecurity is expected to grow to $192 billion just by 2027. That would be from $122 billion this year. That will mean tens of billions of dollars more in revenue just for Fortinet. At a 22% growth in revenue this year, this is actually one of the slower growth stocks on this list, but on a very large scale. That is still adding $1 billion in revenue every year. But one problem I've always had with cybersecurity stocks is the valuation. We can go here to the statistics tab on Yahoo Finance, look here at Fortinet. If we scroll down, we can see that consistent growth in the market opportunity means these things are always trading at 12 and 15 times on a price to sales valuation. Way too expensive for my taste. All you out there in the nation know I kind of have an upper cap of 10 times price to sales for what I'm going to pay even for a growth stock. That recent sell-off though has brought Fortinet down to just 9 times price to sales for a great opportunity to pick up these stocks at a discount. We've still got 3 more of my favorite stocks to buy now and hold forever, but I want to outline what I'm looking for here so you know what to look for yourself. First, I'm looking for sales growth this year and next of at least 20%, and there's more than just growth here. Here I'm looking for growth stocks that are doubling their revenue every 5 years, but also those that are growing faster than their competitors. You can find revenue and earnings history as well as future estimates here on Seeking Alpha. If we scroll down here on the main page for a stock, here we see on SoFi Technologies, we can scroll down and see growth estimates. We can see revenue estimates for this year and next, as well as earnings per share estimates for the stock. Second is I'm also looking for an industry or a theme that's taking all the stocks in that group higher. For SoFi, that online banking and fintech theme is just growing much faster than traditional banking. Finding a growth theme like this, I know that even if I don't buy the very best stock in the group, all the stocks are going to get that tailwind and be pushed up higher because of that bigger picture growth. But then to find the best stocks in those themes, I'm going to be comparing the sales growth as well as the operating margin against its peers. First, I just want to find the leader that are growing sales faster and being able more efficient to turn those sales into profits through that operating profitability. But it's also going to be a clue to some kind of a competitive advantage. Okay, the company that can grow its sales faster might be taking market share away from its competitors, or the ones with a higher operating margin. It's got some kind of a cost advantage that's generating those higher profits. Again, here on Seeking Alpha, you can find both of these numbers, the historical sales growth and operating margin, here on Seeking Alpha under the growth tab. Here we see for Fortinet revenue growth of 30% last year. And then here on the profitability tab, we can see the gross and net margins to compare it against its peers. Finally, and then we'll get back to our stocks to buy list, but I'm not about to pay too much, even for a growth stock. Investors fell into that trap in 2021, and some of those pandemic stocks are now down 90% since then. So I want to make sure that I'm getting a good price, a growth at a reasonable price. For that, I'm going to look at the price to sales multiples. I won't buy anything over 10 times on a price to sales ratio, and preferably, I want to see something lower, like a 5 times price to sales multiple. Next up is a newer stock I'm buying, ChargePoint Holdings, ticker CHPT. I just started adding a position in ChargePoint last month after doing more research into the company and its leadership in level 2 fast charging. I have 14,000 shares, and you can see I've also sold call options on part of that position, selling the $5 strike calls on 5,000 shares expiring January 2025. Now that means I offset some of that near-term risk on some of these by collecting that cash premium, that $5,000, to lower my cost basis. If the shares hit $5 each, then I still make 48% on those 5,000 shares and keep the rest. If not, I keep all the shares and the money. ChargePoint has over 250,000 charging locations and 4,000 commercial and fleet customers. And of course, with this, we need to talk about the big worry on ChargePoint, that Tesla is just going to dominate the market for that EV charging. First, ChargePoint growth is directly tied to EV sales. The more EV cars sold and the more charging stations needed. Just over 1 million electric vehicles are expected to be sold in the US this year. That is less than 8% of total vehicle sales. With that expected to reach 30% by 2030, it means nearly 5 million electric vehicles sold every year, and a booming demand for charging. Then combine this with ChargePoint's dominance in that level 2 fast charging. With level 2 and a home charging port, you could charge your car to 80% in less than 8 hours. It would take up to 50 hours to do that to reach that level on a level 1 port. And since you can do it in those off-peak hours while you sleep, you can charge at 2/3 the cost. ChargePoint has over 70% of the market share in that level 2 charging, more than 7 times its nearest competitor. That is a competitive advantage in this type of the market and is going to keep sales growing even as Tesla competes for a share of the charging market. Another catalyst for this stock, the Inflation Reduction Act money to renewable energy, is just getting started. It's going to drive growth for ChargePoint. Revenue grew at 39% in the most recent quarter and is expected to grow faster at 43% pace next year. And against this huge growth theme, shares are trading for just 2.5 times this year's expected sales and just 1.7 times next year's sales. I see ChargePoint reaching $4 billion in revenue easily within 7 years. At a modest 3x revenue valuation, that is a $12 billion company and a $31 share price for a 650% return. Next up on my buy and hold list is another renewable energy play, First Solar, ticker FSLR. And shares here are down 30% just since July, but is there any doubt we are heading into a renewable energy and solar energy future? The IRA is going to push billions out through customer rebates and tax credits for solar energy. First Solar recently announced its 5th U.S. factory on that new demand for solar panels. The company grew its volume by gigawatt sold by 26% in the first half of the year and has the potential bookings to double that amount. Revenue grew at a 30% annual pace in the second quarter, with analysts estimating that sales can continue at that rate through the next year. But what I really like about this company is it's been able to maintain that operating profitability, that operating margin about 20%. That is rare to be able to keep those sales growth that fast and not let profitability drop a little on higher expenses. Shares here trade for just 3 times on a price to sales for this year's expected sales basis. Here it says 5 times price to sales basis. That is on the trailing 12 months, but this stock is growing sales so fast. It is now trading for just 3 times this year's expected sales. That's down from 8.8 times sales just earlier this year. With that kind of growth, this stock could easily trade at 5 times revenue on an $11 billion revenue over the next 5 years. That is a $480 share price, a 230% return. We've still got one more stock on my buy list, one I'm already up 132% just in the last year, but don't forget, these are all long-term stock picks, stocks that I think will 10x your money over the next 5 or 10 years, but that doesn't mean they're going to pop overnight. Check out this video here for the short-term investments I highlighted in that recent video, stocks that could jump within the next 2 or 3 months. One of the best returns for my portfolio, digital gaming leader DraftKings, ticker DKNG. I have DraftKings in a retirement account, which means I won't have to pay taxes on those gains until I cash that money out in retirement. That is a huge benefit because I can hold the shares for as long as I want, sell for a massive return, and just reinvest all that money instead of paying those capital gains taxes immediately. You can see I'm already at a gain of almost $49,000 and 132% on these shares, but I'm holding for even more over the next 5 or 10 years. DraftKings is live in just 17 states, representing a third of the US population. Not only does the company have a huge runway in states that have yet to legalize online sports betting, but still has expansion into 6 additional states that already have legalized betting where it's already present. In the states where the company competes, DraftKings dominates with 20 to 30% of the market share, second only to FanDuel in most of its markets. With a total addressable US market of $26 billion in sports betting and $48 billion in iGaming, that could take the company to nearly $10 billion in revenue from just $2.2 billion over the last year. The company is expected to grow its revenue by 57% this year and just launched sports betting in Ohio and Massachusetts. It grew monthly players by 40% over the past year to 2.8 million players. And what I really like here, the company is increasing its average revenue per player from $67 to $92 over that year. Not only is it growing scale, but also getting more profitable. Get your $50 promo code and a free trial to Seeking Alpha Premium Access with the link in the description below. Or click on the video to the right and check out those short-term investments, stocks that could double fast. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.